Most Ohio homeowners are shocked to find out what their insurance policies do not cover. And usually when this shock sets in, it's already too late. In this video, I want to go over all of the things that your insurance policy does cover and does not cover. That way you're prepared at the time of loss. In addition, we're going to go over some tips, tricks, and my professional suggestions to put yourself in the best of all possible positions that you could be in whenever you do need to use your insurance policy. My name is Ryan Ingram with Ingram Insurance Group. We're here in Dayton, Ohio, and I have helped hundreds of Ohio families across the state make sure that they have the best coverage for their specific situations at the best of all possible rates. So whether you're a first-time home buyer or you're just doing yet another insurance annual review, then by the end of this video, you're going to know exactly how to read your insurance policy so that you know what it does cover, what it does not cover, things that you should be responsible for, and you'll also know my personal opinion on how homeowners insurance policies should be written. So let's start with what homeowners insurance actually covers. In most policies, there are 5 core areas. This is coverage A, the dwelling, which is everything that is attached to the structure of your house. Coverage B, which is often called other structures. Coverage C is your personal property. Coverage D is loss of use. And coverage E, which is personal liability. Now, there's also a coverage F, which is medical payments, and just very briefly, what that does is if somebody gets hurt on your property, let's say a dog bite, or they are playing in your yard and roll an ankle in a pothole, this will pay for their immediate medical coverages. And oftentimes this is used to pay the medical expenses quickly and avoid lawsuits or large liability claims later on. So first, let's talk about the dwelling coverage. Coverage A covers everything that is attached to the structure. If you have a garage that's attached to the house, this will be included in that number. This covers the walls, the roof, the kitchens, anything that is permanently fixed to your house is included in coverage A. One thing that I don't like thinking about, but makes a lot of sense from a teaching perspective, is coverage A. If you were to pick up your house, turn it upside down, and shake it, coverage A is everything that will still be there when you put your house back down on the ground. Coverage C, which we'll talk about later, personal property, will cover everything that falls out. Coverage B is other structures. Now, this is anything that is outside of your house that still needs insurance coverage. This could be sidewalks, patios, fences, pools, retaining walls, sheds, detached garages, anything that is expensive yet permanently fixed outside of your home. I would recommend including everything that you wouldn't personally want to pay for in the event that a tornado picked it up, hauled it off, or if it were involved in a fire. Other structures usually automatically defaults to 10% of whatever coverage A is. So if your coverage A or your dwelling coverage is $200,000, then automatically your other structures limit will be $20,000. It's really important to take note of this and make sure that you personally inventory anything that you would like to be added to coverage B. A lot of times, one of the biggest mistakes that I see is people will buy their home, they'll slowly build it to be their dream home, which will oftentimes be adding outdoor kitchens or patios, big decks, or beautiful wrought iron fences or aluminum fences. And then a tornado will come through and they won't have nearly the amount of coverage B or other structures coverage that they need in order to make themselves whole after that covered loss. Personal property is coverage C, and that is all of your personal belongings. If you previously had a renter's policy, the common personal property coverages are $20,000 to $50,000. However, once you are getting a homeowner's insurance policy, then your personal property coverage is usually going to be 50 to 70% of the coverage A value. So if your house is worth $200,000, or if that's what coverage A is, then your personal property will be at least $100,000. A lot of times these values are automatically included in your policy, and there's not always much room to move it up or down. With personal properties coverage, you also have sub-limits for things like silver, gold, money, firearms, and art and jewelry. So you're going to want to make sure that you pay attention to these sub-limits, whether it's $2,500 or $5,000, and you're going to want to, what they call, schedule any of the items that are above that. So let's say you have a $15,000 engagement ring, one of the common ones. You'll want to schedule that on its own, as your jewelry sublimit might only include $5,000. In order to schedule any of these items, you're going to want to have an invoice, a receipt, or an appraisal for this item. Oftentimes things like fine art will appreciate over time, and it is good to go ahead and just earmark in the future. You're going to want to regularly review any scheduled items to make sure that in such a hyperinflationary world, you keep your coverage in a manner that will replace these items in the event that they're lost in a fire, a tornado, or any other covered loss. Coverage D is loss of use, and that is what is going to get invoked whenever you have a covered loss that displaces you from your home, whether that's staying at a hotel or renting out a furnished short-term rental, then this coverage will pay for that. And lastly, we have coverage E, which is your liability limits. Now, this is going to cover you anytime, let's say you have guests over, they trip and fall, or you have a dog that bites them. This is the coverage that will be used to protect you in the event that a lawsuit is brought against you. Now, what I oftentimes tell my clients is this is not an area that you're going to want to save money. Usually, nowadays, in such a litigious world, I would say I've seen the difference between $100,000 liability limits, which is usually about as low as you can go, and $1 million liability limits. The monetary difference between those is somewhere between $12 and $70 per year. So usually you're not going to want to save that amount of money in the event that you actually have a lawsuit brought against you and you're looking back at your insurance policy. So unless otherwise noted by the clients, I usually will always max out the liability limits. Now, liability limits usually stop around $500,000 to $1 million liability limits on the policy. It is my recommendation to have liability limits that are equal to or greater than your net worth. Now, that is only possible up until a point, in which case there are additional insurance policies that you can purchase that will make up that gap up until another point. The main one would be an umbrella policy or an excess liability policy. And that means, let's say you had a dog, one of your dogs bit a guest, and the lawsuit resulted in $1.5 million, but your liability limit only went up to $1 million. If you had a $1 million umbrella as well, that umbrella would cover that additional $500,000 in the lawsuit. And just like that, I think you could probably see why it's my recommendation to have liability limits that are equal to or greater than your net worth. You're going to want to make sure that in the event that something horrible happened and an attorney were trying to take you for all that you have in court, you're going to want for that insurance coverage to not leave you and your belongings exposed at all. Now, that goes over the 5 core areas of your insurance policy. Now, things that are not commonly covered, I would say the first of that is flooding. Now, this isn't just limited to like Noah's Ark level and rainbow manifesting levels of flooding. This is just any type of rainwater that doesn't actually make it where it's supposed to go. So groundwater that isn't diverted properly is not covered by your insurance policy. At one of my rental properties, I had groundwater that wasn't diverted properly for many, many years, going completely unnoticed by anyone. Ultimately, the basement wall collapsed. Unfortunately, since it was groundwater, it wasn't covered by insurance at all. Everybody was safe, nobody got hurt. We were able to rebuild that wall. It cost about $16,000, but that's money that we had to pay out of our pocket. The insurance policy didn't contribute, as it was groundwater that wasn't properly diverted. So as a homeowner, on an annual basis, or honestly, I do this each time it rains. I look out all of my windows. I see if there's any water that's making it over the edge of the gutter in places where it shouldn't. You could do this by either watching the rain as it's happening, or afterwards you can walk around your house and see if there's any type of staining on your exterior or at your foundation, if there's any areas where the water has hit, which has caused the mulch or the dirt to kind of splash up on the structure. You should do that as frequently as you feel comfortable or remember, and make sure that groundwater is always going where it is supposed to go. I would highly recommend French drains or trenching out your downspouts as far away from the house as possible. There are many properties that we have where we installed kind of dry wells, or just ultimately dug really big holes and filled it full of gravel and put some grass right on top. That way, and for areas that we couldn't get the rainwater far enough away from the house, and we had no other options but to just divert the water to that larger hole, which would collect it and allow it to seep out over time. If this makes you extremely nervous, then you are able to purchase a flood insurance policy. They are available in all flood zones, including flood zone X, which is what you are most likely in if you are not required to have flood insurance to purchase your home. The government, the banks, and the National Flood Insurance Program are not bashful about requiring flood insurance if you live in a flood zone. And if it's inside of your power, I highly suggest that nobody live near or in a flood zone, because flood insurance is astronomical, and it's also extremely subsidized by taxpayer dollars and the government. So it is likely only to get worse, and there is very little that we can do about it. It's often a common practice to redraw the flood maps to have more people included in flood zones to help subsidize the areas that are actually in flood zones. But let me not get too distracted about my disdain for flood insurance. The next thing that isn't covered is earthquakes. Now that includes ground movement. So just how groundwater not properly diverted isn't covered, if that groundwater also erodes the ground around it, which causes your foundation to shift, that would not be covered. So me personally, I live on a hill. I've got a large retaining wall above my house and a large retaining wall below my house. I regularly, just as I look at the gutters and look for any signs of water not being properly diverted, I will also go around and make sure that the ground is being retained as it should. Anytime I go up my driveway, I'm looking on the side that slopes down to see how much earth we have lost, if any, and different things that we could do to fix it. Earthquake coverage is one of those things that's really expensive. For me personally, it was going to be an extra $5,000 per year for my house. So I decided to self-insure this risk, and because of that, you will find all around my foundation little markers where I'm keeping tabs of the amount of earth that is around my house. Now keep in mind, as we're discussing things that are not covered by your insurance policy, you can add endorsements or purchase additional insurance policies to mitigate any of these risks that really make you uncomfortable. I say that it will get expensive. However, there are very common endorsements like water and sewer backup that you can easily add, and most agents will automatically give you at least something, because it's a very real risk that you probably should be covered for. Which leads us to the next cause that's not always covered, which is sewer backup. Now that's any time that either your drains are clogged, which causes water to back up, either through your shower, through your toilet, or wherever, or it can sometimes happen, and we've had this happen to us at some of our rentals, where the city's infrastructure will get overwhelmed and the storm drains will overflow into the sewer, which would then cause it to back up through one of our houses. So you can install backflow preventers, but usually when you find out about this, it's a little bit too late. Like I said, water sewer backup is an easy endorsement to add, and especially if you have a finished basement, I would recommend adding this. Now this is really expensive. I've got one friend that has a finished basement and he has $250,000 worth of water sewer backup on his policy, and it is expensive. So I would suggest that if this causes your insurance policy to go up too much, that you just know that this is a risk that you're going to take on by yourself and go about doing preventative things to make sure that you are probably not likely to experience one of these losses. Now, general wear and tear is also never covered by insurance. You can buy equipment breakdown coverage, which covers the mechanicals of your house, furnaces, water heaters, AC units, even refrigerators and stoves. And what this will do is if you are in like a lightning storm and it causes a surge and kills one of these appliances, then it could be covered under the equipment breakdown. However, again, this is not coverage under the wear and tear. Expensive jewelry, art, these are things that you're going to want to schedule, and they are not naturally covered by your insurance policy. These are going to be items that exceed the sublimits of your personal property, and you're going to want to make sure that you add these items as you acquire them. Also, one thing that is not covered is your underground service lines. Oftentimes the electrical lines, either from the pole to your house, those are going to be your responsibility. The sewer line from the street to your house, your responsibility. The water supply line from the street to your house is going to be your responsibility. When these things break, you usually have to get in very heavy equipment and either dig them out to repair them or install new ones. Now, you can get an endorsement for, I've commonly seen about $10,000 for underground service line coverage. And this is usually just a couple of dollars per year, maybe probably less than $20 per year on your insurance policy. So it is something that you're going to want to add. Now, if you live very far away from the street, then it is likely going to exceed the $10,000 limit of this coverage. And what I would recommend, and what I have done to my personal house, is use a company called Homeowners. And they are like a small insurance policy for a very specific item. So that's just a couple dollars per month. And it gives me peace of mind knowing that whenever one of these lines go bad, then I'm not going to be the one writing the very large check for that. So those are all the things that are covered by your policy and several of the ones that are not. So if any of those that are not covered cause you any levels of concern, what I would do is recommend that you go out and purchase an additional insurance policy or endorse it on your policy in order to get that peace of mind and the appropriate coverage for you. Now, what I would recommend if you are a first-time home buyer or are looking to close a house, sometimes if you're close or on the edge with your debt to income and getting this house closed, I would just go in with the bare bones insurance policy and endorse these policies and add all of the extras to your insurance policy after closing. A couple of other things that you should know about your insurance policy that may impact the premium or how much you pay on an annual basis are the deductibles and the coverage or loss options. So your deductible is going to be the amount of money that you are responsible for at the time of a claim. I have personally found that about $2,500 is the sweet spot, and sometimes $5,000. If you go much higher than that, then the savings is prohibitive, where if you go from 5,000 to 10,000, you might only save $100 per year. And writing the check or covering the difference between $5,000 and $10,000 would take a significant number of years to recover from at a rate of savings of $100 per year. Similarly, if you go less than $2,500, you're usually paying more, whereas if you just increased your deductible and put the extra money in your pocket, you would cover that $1,000 to $1,500 difference in a couple of years, because it would likely add several hundreds of dollars to your premium. So $2,500 is about what I suggest for your deductible. Next is replacement cost versus actual cash value. Replacement cost is calculated for coverage A. So your coverage A is usually going to be the amount of all the materials and the labor to restore your house exactly as it is in its current condition. So replacement cost, very strictly by the letter of it, promises to put your house exactly as it is prior to the time of loss. So if you have plaster walls, replacement cost promises you plaster walls. If you have a slate roof, then replacement cost promises you a new slate roof. Now this generally is going to add a lot to your premium, especially if you live in one of these older homes that Ohio is known for, where they were built in an era far gone of extremely high quality construction materials. In addition to the cost of the materials, the labor is also more difficult to find. It's very skilled to work on slate roofs. When we had one slate roof that we needed repaired, we had to wait over 8 months for a qualified person to come out and repair it. You can mitigate this by adding what's called functional replacement cost to your policy. And that's not promising you plaster walls for plaster walls anymore. This is now promising you a wall for a wall. So instead of plaster, you'll get drywall. Instead of slate, you'll get architectural shingles, and so on. This is usually a way to save money on an annual basis. However, if you are a historic home purist, then this is probably not what you're after. Now, actual cash value is replacement cost minus depreciation. As a general rule of thumb, depreciation is calculated by 1% per year. So if you have a house that is 50 years old and you have a partial loss of $100,000, then the actual cash value will depreciate 1% per year by 50 years or 50%. So in that partial loss, you will get $50,000 instead of that $100,000. Now, keep in mind that the actual cash value is only really important in a partial loss. If this were to be a total loss, let's say a fire were to burn your entire house down, then you're going to get whatever coverage A is, and you're going to max out that claim. It gets more nuanced in that, let's say it's a kitchen fire and you remodeled your kitchen in 2022. Well, at the time of this video, it's 2025, you would likely only have 3% or 3 years depreciation. So instead of getting $100,000, you would get $97,000. Now, not all companies will honor actual cash value depreciation by the renovation date. So that's something that you're going to want to specify with your insurance provider at the time that you are writing this policy. Insurance is one of these things that it is just a pure promise up until the day that you need it. So this is an industry that is just completely dominated by trust. You are going to want to make sure that you're working with an independent insurance agent that you can trust. I would be weary on taking recommendations from realtors or loan officers. Just because they work with them frequently doesn't mean that they're going to be a perfect fit for you and going to be somebody that you want to work with, especially during the vulnerable time of a loss. So I would not only vet them personally to make sure that your agent is somebody that you want to spend time with, that you trust, to have not only your best interest, but actually show up and perform at the time of a loss, because insurance is a promise up until the time that you truly need it. And it's at that time where it's too late to make any adjustments or do anything different than what you've already done. And the reason I say an independent agent is they have access to multiple companies. you could call in to State Farm or Progressive or Allstate, and you could get an insurance quote from them, and you could tailor it to be exactly what you need. However, they only have one product that they're going to be able to give you. So in the event that your premiums start to increase year over year, then they really can just encourage you to stick with them, and that hopefully rates go down. They could provide you some type of comfort that's not just you, but they don't actually have anything additional that they could provide you. It'll then be up to you to go around and make these phone calls and get other quotes. Whereas if you were to work with an independent agent who has access to several different companies, then it's just one phone call and they could shop you around and all your coverages to different carriers to see and make sure that you're still getting the most competitive rates. And that's really the end game of these independent insurance agencies like the ones that we have. And please give us a call if this video has earned your trust, because I hope to hand this business down to I've got 7 children, and it's my hope that one of them will take over this business. And it's my hope that my children will write the insurance for your children. It's a long-term play, and it's one that is, again, predicated on trust. So with that, I think you are now very well qualified to read your insurance policy, understand what the best coverages are for you and your family, and make a good determination on who you're working with as an agent. If you have any questions, please don't hesitate to reach out. Our information and our Google page is linked below. So thank you so much for watching, and I look forward to working with you soon.